to today's webinar over here. So before we get started, I'd like to very quickly introduce and share with you a little bit about today's sponsor. So today's webinar sponsor is by PXBT. They are fairly new in the market. However, they are currently running quite a interesting promotion for all traders to test out their platform and to receive feedback. And of course, they also focus a lot on education, and that's the reason why they are supporting today's webinar, so that you guys can actually receive this education for free too. Now, for those of you who are fairly new to PXBT, first thing first, you do see a QR code on the left hand side. You can actually scan this QR code. It will direct you to a website. You can actually register for your own account, get it verified. And the current bonus that we are running over here with PXBT is that you can make a deposit, and on the left you can see you can receive up to 50% and 30% deposit bonus, but for today's special, for those of you who attend today's webinar, you're able to receive up to 100% deposit bonus with a maximum of $1,000. Now what this means is that today, if you get your registered account verified and you make a deposit, for example, if you put in $100, you're gonna get another $100 as a deposit bonus. So in total, you have $200 that you can actually use to trade. Now on top of that, today we also have this offer by PXBT. All trade that you'll be taking will be in zero commission, so there's no extra charges. And in the link description below of this video, you'll be able to get the person in contact. The current promotion they are running also is you are able to get a rebate of $20 directly back into your bank account as a form of welcome bonus. Okay, so if you'd like to find out a little bit more about PXBT, feel free to scan the QR code, go over to their website, register a free account, and of course any inquiries, do direct them to Nate directly. You can find the contact below in the description. So with that said, let me jump over and get started with today's content. Okay, now today's content over here will be focusing on trade setup. So the previous session we cover on directional bias, right? How do we establish direction using the Elliott wave principle, so that we have a idea in terms of do we want to be focusing on buy and sell. And today's focus will be very much on timing. Now when we talk about timing, we need to then establish what is a setup, right? What's the strategy that allows us to actually execute trade. Now there are many strategies out there. Today we're going to be focusing on order flow. Now order flow, one of the unique things, and I would say one of the advantage of this, is that it is very mechanical, and the beauty behind it is it's pretty straightforward and simple. There's really no guesswork from here. Okay, so what I'll do in today's session here is to cover a little bit in the theory part of it, the concept of it, so that you understand the framework of this strategy, and then I'll jump into some of the live chart here to walk through with you guys. Okay, so let's jump into the first understanding. We have two types of setup, right? So obviously one is to trade the trend continuation following the previous prevailing direction of the market, and the other setup is basically a counter trend setup. Now to be honest, they're pretty similar in nature in terms of the framework itself, but the whole idea here is you need to be just clear. Are you trading in line with the overarching direction, okay, or are you kind of trading a short-term retracement? So that's the part where, again, direction, establishing your directional bias is important, because you want to have that overarching idea before committing and executing any trade. Okay, so let's talk about the general steps, right, in identifying a setup, a criteria for you to enter a trade. Now there are 4 steps over here. You can see first is to identify market structure direction. Now what do I mean by that is you want to first establish, right, on the lower time frame perspective as you are entering trade, is the market in a bullish market structure or is it in a bearish market structure? Now this is important because ideally when you're taking a trade, you want the setup or say you want the market structure direction to be in line with your directional bias. Okay, so give you an idea, right? If today you're looking at a 4-hour time frame, you're establishing your directional bias, and you figured that there's a high probability the market will actually move higher, or you can be utilizing, for example, fundamental analysis to help you establish and say, all right, the directional bias here is bullish, right? You have a high probability the market will move higher. And then if you want to look for setup, you want to look for entry point, that's where you drop down to perhaps a lower time frame like the H1. And what you want to do is to identify, is the H1 time frame market structure in alignment with your higher time frame overall market structure. Now obviously if it's not, then it's not going to be an ideal setup, but if it is, then that's where you can proceed to your next step. Right, so the next step over here is to identify order block, right, which is essentially where are the areas of supply and demand. Now I'll dive a little bit into the detail as to how do we establish order block. Okay, but the idea behind order flow is the order blocks are areas of interest, right, or I'll say POC, right, point of contact. Now these are the areas on the charts that you want to pay attention, because there's a high probability the market will react off it, and that's where we're utilizing these areas as our entry zones. So the entry, as stated over here, okay, will be basically using the order block, and it's going to be near the order block. And on top of that, what we'll be doing is we'll also be utilizing Fibonacci ratios to find confluences. Okay, so as we progress in some of the charts later on, I'll show you what are the fit ratios, how do we pull it as well. And last but not least, once we have established our order block, we know where we are going to look for entry. We also need to establish where are we going to put our stop and target, right? So for our stop and target, we're basically utilizing our previous swing highs and lows, just to ensure that, you know, if you are trading on the upside, then the stop will be at the swing low. If you are selling it, then our stop will be at the swing high. Now, very quickly, let me show you the bullish market structure model. So what you're seeing over here is, first you can see we have a market structure break. Okay, what's a market structure break is basically breaking highs and lows. So if you're in a bullish market structure, we want the price to be breaking the previous swing high. Okay, the whole idea here is pretty similar to understanding a trend. If you have higher high, higher low, the market is essentially making a move to the upside, right? So in a bullish market structure, you want to have some form of a confirmation where price breaks previous market high. Okay, we call this market structure break, or we also utilize another term called break of structure, BOS. Okay, now once we get a market structure break, we are in a bullish market structure. We want to then identify our order block. If we are looking at a bullish market structure, we're interested in the buy side of things. The order block naturally will be a demand, and we'll be waiting for the market to pull back, right, towards this area here and look for our entries. Okay, so you can see over here the swing low will be essentially where our stop is going to be, and the next high is where our target is going to be. Now very quickly, if you flip this, this is an example of a bearish market structure, pretty similar, you just mirror it. As the market moves lower, it has a market structure break, confirmation of a bearish move. You identify order block, which is supply zone, if you are looking to sell it, and our entry will be around the supply. Swing high is our stop, and of course the previous low is our target. Pretty straightforward once you understand it, right? But let's jump into a little bit on the details of things. Okay, now I believe identifying market structure break or break of structure is pretty simple. Okay, as long as you understand how the market establishes swing highs and lows, identify market structure break of structure isn't difficult. Okay, now maybe I'll just jump into the charts over here to kind of highlight a little bit. Right, so you can see doesn't matter what time frame or what chart. Okay, this is obviously an uptrend, right? So what you see over here is the market actually make a move higher, it retraces, right? So that forms a swing high, and then after it retraces, it starts to go higher, that forms a swing low, right? So we have a high, we have a low, and as the market continues to progress higher, you realize that it managed to break above that previous swing high. Okay, Now the important thing here is it needs to break and close above, right? Sometimes it wicks above it and then it just immediately retraces back down without closing above that previous high. That's not a break of structure, that's not a market structure break. You want the market to break and close above, so this is called a market structure break, or BOS, break of structure. Right. So once we have a break of structure, right, as long as it starts to break above it, we are in a bullish market structure. Okay, this is already in a bullish market structure. Of course, what the market did is it continues to go higher, higher, higher until it starts to do another pullback. Right, so we have a swing high, we have a swing low, and as of last week, you can see the market actually took off the previous swing high too. So that's a new break of structure. So essentially, this chart example, you can see the market is just moving higher, forming higher high, higher low, right? So that's what a break of structure means. Okay, now if I flip it to another chart just to illustrate what a downtrend bearish market structure looks like, you can see from here the market came down from a low, okay, retraces from a swing high, move lower, break and close above that previous swing low. So that's a break of structure, right? And then it keeps going down from a swing low, does a little bit of a retracement from another swing high, and it managed to break and close below as well, right? So I think this is again a very classic example of bearish market structure. Right, so with all that, okay, once you establish your market structure itself, the next step is to identify order block. Okay, so how do we identify order block? The first thing you need to understand is the principle and the concept of fair value gaps. Now, what are fair value gaps, or in short, FVG? Fair value gaps are often created when the market momentum is very strong. Now, I still remember previous lessons that we went through. I introduced you to the term called impulsive move, which is when the market actually moves in a particular direction with momentum or a very strong move, right? So fair value gaps are often created when we have impulses in the market. Okay, and if you're more familiar with equities or indices, you realize that these markets tend to have gaps because they are not 24 hours. Those gaps are essentially fair value gaps as well, because the market actually moves in a particular direction strongly when the market is closed. However, today, if you're looking at the currency bull, we don't have gaps as frequent, right? So what we need to have another pattern structure to identify where these fair value gaps are. Okay, and we are using a 3 candle pattern formation to help us identify fair value gap. Now, giving you some examples before we jump into the charts. You can see over here, it's a 3 candle pattern, right? So as the market is moving up, you realize in this example, candle 2 is huge in its body, means that it carries huge momentum. Okay, so that's a indication that a fair value gap may be there. Okay, now what's the confirmation is when we see that the first candle and the third candle didn't overlap. Okay, so what you realize is that the high of our candle 1 and the low of candle 3 did not touch one another, right? So that leaves a gap between them, and this gap is essentially our fair value gap, FVG. Now when the market is coming down, same thing here, you can see candle 2 body is pretty huge, and candle 1 and candle 3 did not overlap. Okay, the low of candle 1 and the high of candle 3 did not touch one another. So that gap itself is the fair value gap. That's the FVG. Okay, so today if you jump over to the charts, okay, let me just bring one example up with the most recent one. Okay, you can see over here, right? This candle is huge, very obvious. Okay, that's a momentum candle. Often that's a clue that a fair value gap may be created. And then you can see, okay, previous candle is here, third candle is here. That's the huge candle. The first and the third did not overlap. Okay, they did not touch one another, and therefore this area creates the fair value gap. That's your FVG. Right, I'll give you another example. Okay, same thing here. As the market is going up, you can see that's a huge momentum candle. Okay, very strong. And the first candle here, third candle here did not overlap. So what does it forms? This forms a gap, and that's essentially your FVG. Okay, so this principle is pretty straightforward, right? I mean, you'll be able to find the fair value gap quite easily with momentum candle, right? So you can see here, this huge candle forms a little bit of a fair value gap. Okay, this here forms a little bit of a fair value gap as well. Okay, now bear in mind, we don't trade every fair value gap. We don't just trade because there's a fair value gap, but the fair value gap is essentially telling us that it's a confirmation sign the market has a momentum move, right? Because fair value gaps are left behind when the market moves off impulsively. Okay, so bear that in mind. Okay, now with that said, okay, once you're able to identify where these fair value gaps are, there's a very high possibility that the order block is near the fair value gap. Okay, why? Right? What's the logic behind? Because today, if the market moves off with momentum, right? If it's going up with momentum, there are some forces that pushes price up, right? And what would push price up? Essentially, they are your demand. When demand comes in, it pushes price up. When supply enters the market, it pushes price down. So whenever the market leaves behind the FVG, it kind of tells us a hint that either demand is coming in or supply is coming in. Okay, so one of the easiest clue and hint in terms of how we can identify order block is using fair value gaps. Okay, so once we have a fair value gap, the order block that creates the fair value gap is essentially the supply or demand zone. Right, of course, if today is in a bullish market structure, we're interested in the buy side of things, we'll be focusing more on the demand or the block. If you're in a bearish market structure, then obviously you'll be more focused on the supply or the block. Okay, so coming back to the same model, you can see this is a fair value gap. Okay, just before the fair value gap, that's where your demand zone is created. Same thing here as the market is coming down. Right, that's where your supply zone is created. Okay, now let me jump back onto the charts to give you an idea, more details in terms of like how we identify the order blocks. Okay, now there are advanced levels in terms of like how we can use to identify all these areas, but again, it's not going to be complex, right? So first thing first, right? Let's focus on the obvious one. This is a fair value gap, right? Very, very obvious. So what you realize is before the market pushed to the upside, we have the market coming up a little bit, does a little bit of a retracement before essentially moving up with momentum, leaving behind fair value gaps and of course a break-off structure. Okay, so the key area before the impulsive move, before the fair value gap was created, was this retracement zone, right? The period where price is retracing. Now, what I love to do is always take the start of the retracement to the end of the retracement and put in rectangle box, right? Basically zone up that area, and that area is essentially our order block. Okay, because this is the area that creates the momentum push, and very importantly, this push also causes a break of structure. Okay, now if you look back a little bit, you can see there's a little bit of fair value gap here, right? The market retraces before the push up, breaking that previous structure high as well, which is a market structure break. The retracement area is our previous demand zone. When the market pulls back towards that demand zone, we have a little bit of reaction. The market continue moving higher. Same thing here. We have the fair value gap, right? So where is the demand zone? The market went up, does a little bit of pullback, pushes higher again, and therefore the retracement zone is essentially our order block. That's our demand zone. Okay, now this demand zone is fresh, right? What it means is that the market hasn't really come back and retest that yet. So fresh order block, okay, whether is it fresh demand zone or fresh supply zone, that's important, okay, because this means that when the market come back and retest this area in the future, there's a very high probability it will have some sort of a reaction. Now, areas in which the market has tested it before, for example over here, okay, we don't trade this area anymore unless it creates another new one such as this. Okay, so when we are trading order block and we are focusing on supply and demand, we only want to focus on areas which are fresh, which means not tested. Okay, now I'll give you another example as the market is coming down. So this one here, you can see same thing, right? We have fair value gaps. Okay, the market came down, that's a little bit of retracement before the push down. Therefore, this is a supply zone. It's fresh because the market has yet to test it before. Okay, then next we also have a little bit of a supply zone here. Okay, and you can see here we have a little bit of fair value gap. The market retraces before the push down, but this supply zone has been tested. Okay, so this one we're not going to be too interested in because the supply zone has been retested and the market reacted off it already. Okay, same thing here, we have a tiny bit of a fair value gap. Okay, we have the pullback that creates the supply zone, and of course the supply zone has been tested successfully. Okay, so that's something to note, right? Again, over here you can see as the market comes down, right, there isn't much of a fair value gap in this move. Okay, so again, nothing significant, so there's not much of a clear supply zone. Okay, so bear in mind, okay, you don't want to just immediately jump into the chart and start looking for supply zone. The idea is first start off with fair value gaps, right? Do you have a momentum push? Usually when we have a momentum push, we have a fair value gap. That's where we are going to start looking for supply and demand, right? So with that in mind, how do we execute and look for entry? Pretty straightforward. Okay, once you have your bullish market structure or bearish market structure, you have fair value gap, and you start to be able to identify where these order blocks are. Okay, our entry area would be within this order blocks, whether is it going to be demand zone or supply zone. Right, so our entry is where the order block is. Our stop loss is at the previous swing low or swing high, depending on whether you're buying or selling, and then your take profit is just at the previous highs and lows. Okay, now oftentimes the risk to reward ratio of the setup is going to give you at least an average of 1:2. Sometimes it can go a little bit higher, but that's the average that you want to aim for, right? Risking 1% to potentially make back 2 times, right? 2% of it. Now what I'd like to add on, right, is that today I'm going to utilize a little bit of Fibonacci as confluences as well, and the Fib areas here we're looking at is 71%. Okay, so I'll use this example, right? We have a bearish market structure. Okay, I'll annotate a little bit over here. We have the market breaking that low, right? So that establishes a break of structure. We have the fair value gap. Okay, pretty obvious. So this here creates the supply zone. Okay, so where's our swing high? Our swing high is here. Our swing low as of now is here. Okay, so what I would like to do is I would take Fibonacci from swing high, pull it to swing low. Let me simplify this a little bit. Okay, we'll be focusing on the 71% retracement. Okay, and obviously our swing high here will be 100%, and then our swing low here will be 0%. Okay, so the 71% oftentimes would align very nicely with where our order block is. Okay, so that's what we call a confluence. Now when we have this, very nicely our entry in this case will be a bearish sell, will be where that 71 is, which aligns pretty nicely in our order block at this moment. Our stop is at the previous swing high, our target is at the previous swing low. You can see the risk reward over here is about 2.2, right? Pretty neat, right? This is a very classic example of nice confluence, right? 71%, just nice at the order block, right? So what we would love to see obviously is for price to start retracing back. Okay, ideally this retracement shouldn't be impulses, right? You want this to go up correctively, tag the 71 and give us a nice little reaction with a continuation to the downside. Okay, I'll give you another example as the market is going up, right? So in this case here, same thing, we have a break of structure. Okay, break and close above is a bullish market structure. We have fair value gap, very obvious, created. We have this retracement, that's your order block, your demand zone. Where's your swing low? This is your swing low, that's your swing high. What we do, we take fib for additional confluences. We take from swing low to swing high. 71% is just where that order block is. Okay, so our entry would then be at the 71. Our stop is above that swing, below that swing low, and our target is just at the swing high, right? Again, risk to reward 2.3. Right, very simple, very mechanical approach of a strategy and a setup. But of course, you need to do a little bit of practice. You need to be familiar with all the principles and concepts that we covered. But that's how the strategy works, right? And of course, okay, you don't want to jump into the strategy immediately when you open up a chart. You always want to first establish your directional bias, which we covered in the previous lesson, right? Okay, so going back to the charts over here, to the PowerPoint to share with you a little bit. Okay, in this bullish model, you can see how the market reacted off nicely. Obviously, not all trades are going to work out perfectly, but it's a high probability model. Okay, then a bearish market structure model. Similarly, right, we have our entry, stops, and take profit, and the price actually reacted off very nicely. Okay, so that's the strategy, that's the setup that I'll be looking at. Okay, using this mostly for my trading as well. Just to cover a little bit in terms of like the time frame perspective. If you are looking at swing trades, you can obviously look at H4 for your potential entry setups. You can also play around with the lower time frame like H1. Okay, so often what I'd like to do is I'll use the H4 to establish my directional bias. Once I have a clear direction to focus, I'll drop down to the H1 time frame to look for my entry. Okay, using the setup model. Now, if you're more of a short-term trader, intraday trader, you can also utilize the model of like using a H1 to establish a direction, and then maybe on the 30-minute on the M15 to look for your setup. Okay. Now, personally, I would suggest if you're fairly new to trading, to stick towards the H1 as the minimum lowest time frame, right? Because the lower the time frame you go, the more, I would say, the more active you need to be in monitoring the market. Okay, the more time you need to spend monitoring your trades as well. Okay, so if you don't have that ability to do it, you don't have that flexibility to do it, then stick towards the minimum time frame of execution at H1. Okay, now can this be utilized on any instrument? The answer is yes, right? You can use it on the FX market, you can use it in gold, you can use it in commodities, you can use it in stocks, you can use it in indices. Okay, now just to give you a opportunity here to keep an eye on moving forward as well, okay, depending on when you're going to be watching this webinar. We have a potential setup here in silver, right? So if you take a look at the directional bias, right, if you kind of follow and remember what we went through the previous session, okay, the market came down, we had a little bit of a break here, pretty strong momentum to the upside, a little bit of a pullback. The market seems to be pushing higher as of now. We have certain sense of directional bias, right? Of course, fundamentally here, we are bullish on silver as well, right? So directional bias wise, pretty clear cut, right? We have established that. Now, once you have a direction, you want to have a setup, right? You need to know which price to enter, where you're going to put your stop, where you're going to put your target. Then you can manage your positions, right? So going down to the lower time frame, what do we have? Okay, you can see over here, we have a market break of structure. right? So that's your previous swing high, right? The market came down, forms a high, forms a low, and then as of now, the market break and close above the swing high. So that's a break of structure. The market initially were in a bearish market structure, but after this break, it's transiting into a bullish market structure. Now, in this bullish phase, right, as the market is going up, do we have fair value gaps, right? Might not be the most obvious, but we have a little bit here. You can see that, right? This candle is a little bit of momentum. The first candle and third candle did not overlap. Now, there's a minor pullback here, so that becomes our demand zone. Now, if I'm going to take Fips, pulling from swing low to swing high as of now, we have the 71% confluencing nicely at where the order block demand zone is. Okay, so just based on what we're seeing now, we have an opportunity to get long, right? So that's the setup. We will be waiting for price to come into this area, stop below that swing low. Target here, very conservative, will be where the previous swing high is. Obviously, you can always have extended target if you're a little bit experienced, okay? But for this sharing here, we're just gonna keep it simple, okay? So with that, you can see very beautiful risk to reward ratio, 2.2. Okay, very clear entry, very clear stop loss and target place. Okay, so this is an example, okay, in a practical market example that we have as of now. Okay. So I hope that's clear. Again, very simple, straightforward strategy and setup over here. Okay, high probability trade setups, right? But of course, don't jump into the chart and then immediately start looking for these setups, right? Go with the flow as I covered. Establish your direction bias. Identify your market structure. Okay, follow those steps. Look for fair value gaps. Look for demand supply zone. Utilize a little bit of Fips as confluences, right? So those are the processes and the steps, right? Hopefully, that's clear. Okay. So I hope today's sharing is clear, and of course just want to very quickly come back to this again in case some of you miss out at the start. Okay, today's sharing here is supported and sponsored by PXBT. Okay, again you can see on the left there's a QR code over here. If you're new to PXBT, okay, do scan this QR code. It will lead you to a web page where you can actually register for your free account. Now, today, there are currently various promotions that they are offering. One of it is basically a 100% deposit bonus, right? So you see on the top left here, that's the 50% and the 30%. But for those of you who are attending today's session, you're able to enjoy up to 100% deposit bonus at the cap of $1,000, right? What it means is that if today you fund $100 into your account, you will get an additional $100 that you can use to trade. So in total, you have $200 in your capital. Right. Now on top of that, currently you can trade with 0% commission, so there's no extra charges in the trades they are taking, and you are able to get a $20 rebate directly back into your bank account once you're registered, verified, and make a deposit into your trading account, right? So for that, you can actually contact Nate directly. You can find his contact information in the description link below. So with that, I hope today's session has been insightful and able to provide with you guys some ideas in terms of how to approach the market. Okay, a strategy, a mechanical and consistent strategy that you can actually add it into your toolbox, and hopefully that helps you in your trading too. Okay, so all the best, and I'll see you guys in the next one.